All right, let's jump right in. Today, we're tackling one of the biggest questions every investor has to ask themselves. Where do you put your money? Do you back the steady, reliable giants, what we call blue chip stocks? Or do you bet on the daring pioneers, the growth stocks? Let's figure out which path might be the right one for your journey.
So yeah, think of it like this. Do you want your money to work like a steady giant? Something that can weather the storms and just keep delivering consistent results? Or is it more like a daring pioneer, venturing out into brand new territory with a shot at absolutely massive rewards, but yeah, facing much bigger risks along the way? That's really the heart of the choice we're digging into.
Okay, so let's properly introduce our two contenders. We're going to break down both of these investing paths so you can see what they really mean for your portfolio. First step, we've got the steady giants, blue chip stocks. These are the names you already know, right? The ones you trust. We're talking about companies like Coca-Cola, Johnson Johnson. They've been around forever, they pretty much own their industries, and they have a long proven track record of making money. People see them as safe, reliable, really the backbone of a solid portfolio. And a big reason for that is they usually pay out regular dividends. And then on the complete other side of the ring, you've got the daring pioneers, growth stocks. Just picture a young Apple in your mind, or a company like Tesla right now. These are the businesses that are growing their profits and revenues at a crazy fast pace. And here's the key difference: reinvestment. Instead of handing you a dividend check, they pour every single penny of profit back into the business. Why? To innovate, to expand, to grab more market share, all to fuel their potential for absolutely huge returns. Okay, so now that we know who's in the ring, let's put them head to head. Let's really break down how these two investing philosophies stack up against each other. So the first big difference is stability versus volatility. Look, blue chips are famous for just steady performance. They're probably not going to double your money overnight, but the flip side is they're way less likely to totally crash when the market gets shaky. Growth stocks, though, they live a much more exciting life. They can have these massive price swings, which is great when they swing up, but it also means there's a real risk of some pretty significant drops. Next up, what do they do with their profits? We kind of touched on this, but blue chips often reward you directly with dividends. That's a fantastic way to get steady income, especially if you're, say, retired. Growth stocks, totally different playbook. They take all that money and plow it right back into expanding the business. So if you're a growth stock investor, you're not looking for income. You're betting that the stock's price itself will go way up as the company gets bigger and better. And this table here, it just lays out that core trade-off perfectly. You can see it right there. With blue chips, you're talking lower risk, but also smaller reward potential. It's really ideal for long-term stability. Then you look at growth stocks. You're dialing up the risk for sure, but in exchange for the chance at huge rewards. That just means you have to be okay with some pretty wild swings over the long haul. All right. Theory is one thing, but let's see how this stuff actually plays out in the real world. Let's look at some stories from the road with real companies that perfectly capture these two different paths. So let's start with the absolute classics. You've got companies like Coca-Cola and Johnson Johnson. They are the dictionary definition of a blue chip stock. For decades, and I mean decades, they've delivered consistent dividends and dependable performance. Look, they're not going to be the most exciting stock in your portfolio. They're not grabbing headlines every week, but they are the definition of reliable, long-term investments. Now, compare that to a company like Tesla. Wow. It is the quintessential growth stock, right? It's constantly innovating, scaling up, just completely disrupting entire markets. And its stock price, it has been on an absolutely wild ride. The volatility is intense. But for the investors who got in early and had the stomach to hold on through all those ups and downs, the gains have been nothing short of extraordinary. And then you have this really fascinating story in the middle, Apple. If you go back, say, 20 years, Apple was a pure, unfiltered growth stock. It was pouring every dollar into game-changing products. And the people who believed in that vision, they saw incredible returns. But today, Apple has matured. It's a giant. And it acts a lot more like a blue chip now. It even pays a dividend, but it still manages to innovate. It's just such a powerful reminder that these labels aren't permanent. Today's daring pioneer can absolutely become tomorrow's steady giant. Okay, so let's pull all this together and do a quick recap, a really clear look at the pros and cons for each of these paths. So what's the good news? Well, for blue chips, it's all about that stability, that sweet dividend income, and just plain lower risk. For growth stocks, the appeal is obvious. It's the potential for massive returns and the thrill of being part of a huge innovation story.
But, of course, there's always a flip side, right? The downside for blue chips is that their growth potential is pretty limited. You're just not going to get that explosive upside. And for growth stocks, the cons are pretty serious. You've got higher volatility, no dividends to fall back on, and let's be honest, a much greater risk that the company just might not make it in the long run.
So, after all that, we land on the single most important question: which path is right for you? This is where we stop talking about companies and start talking about your own personal financial journey.
And to figure that out, you really need to ask yourself 3 key questions. First, what are your financial goals? Seriously, what are you saving for? Retirement? A house down payment? Second, what's your risk tolerance? Like, can you actually sleep at night if your portfolio takes a 20% hit? Be honest with yourself. And third, what's your time horizon? Are you investing for the next 5 years, or are you in this for the next 30?
But after we've laid out this whole one versus the other battle, here's maybe the most crucial point of all. You don't actually have to pick a side. In fact, the best strategies almost never force you into just one camp.
And that's because a lot of the time, the smartest strategy is a blend of both. You can build a portfolio where the blue chips act as your solid, stable foundation, kicking off that steady income, while a handful of growth stocks are in there to add that potential for really exciting, maybe even life-changing returns. It's all about finding the right balance. And so that's the question I want to leave you with. When you think about your own goals, your personal comfort with risk, and your timeline, what does that right balance between the steady giant and the daring pioneer look like for you? Really thinking about that, well, that's the very first step on your own investing path.